Hey, this is Hutch with bankingtruths.com, and today we're going to talk about should you leave your safe and liquid reserves inside a high yield savings account now that they actually are giving you a high yield. They used to say that when the rate started with the dot, now it's paying like over 5. Or should you put it in one of these whole life policies to be your own bank with? And to support our claims, we're going to actually look at old yield data as well as policy data to find out, because nobody knows which way rates are going to go. But here's what they've done for the last 2.5 decades. And you can see these 2-year treasury yields, which are close to what you're going to get in these high yield savings accounts, are pretty high right now. But also notice that they're very noisy. You can tell that as the economy is very frothy, like it was in the late 90s. These yields get higher to tame inflation, but then a recession hits and they go down, and then they get higher again before 2008, and then they go down and stay down for a long time. Again, things get frothy like they did towards the end of last decade. Then they go down and they're spiking again. So could they go back down? There's a lot of very good reasons why they might. But could they go up? Like they did in the early 1980s, we see this spike is unprecedented, and these are short-term yields. We can also see if we overlap 30-year treasury yields next to the 2-year, that's the orange line over the blue line, we can see that we're in a period of what's called an inverted yield curve, where the short-term yields, the 2-year blue, spikes higher than the long-term yields. And what that means is the smart money, the institutional bond investors, don't believe that the short-term yields are going to stay that high for long, because they won't raise the yields on the longer term above them. They just believe that things are going to come back to earth. Nobody knows for sure. That's okay. We're going to use this data to model what would have happened if you stayed in high yield savings or a life insurance policy. So we're going to use the example of 100K. We find a lot of our clients like to keep around 100K in safe and liquid reserves in something like checking and savings. And there's a lot of gravity to keeping it there as opposed to deploying it over time. We're going to use the example of over 10 years into a life insurance policy. And the reason they don't, it's because checking and saving is familiar. It's simple. They understand how it works, and it's free. Who doesn't love a free 5-ish% right now? Conversely, life insurance, it's unknown. It's not simple. It's complicated. You have to have these crazy guys on the internet explain how it all works. And it seems expensive. You get good yields in the future, but you have to take this hit to early liquidity for a year or two, and nobody likes that. But if you were to do it, here's what happens over time. Now, this is an old slide. It says low to no growth. Nowadays, you're actually getting pretty decent growth in a checking account. We're going to look at that. Used to get even better growth in the 80s. We're going to look at that too. With life insurance, over time, you will actually get, I put stronger growth, but we'll just say steadier growth. But don't worry, we're going to model it all for you. Now, this is a big one. In checking and savings, you're going to pay taxes on that growth, versus with life insurance, it's a tax-exempt vehicle. Now, there's a drag with term insurance. If you keep money in checking and savings, you have to also write checks for term insurance. You don't for whatever amount of built-in protection you have. We're not even going to show doing term insurance because some of you are like, I don't want it, I don't care for it, I don't need it. No problem. This is also a huge one. When you use the money in your checking account, you have to pull it out. And so it kills that compounding. You're no longer earning the 5%. Versus with life insurance, you can continue to compound that money, borrow against it, not lose your place in line with the insurance policy. And as you pay the loan back, you end up at a higher place in line. Regardless, we're going to use this calculator to go all the way back to 1980 to where we can see yield spiked over 16%. And we're going to start with that yield. And over time, the yield obviously goes down, but it's pretty good for a long time. And it really doesn't start to flatten out until about the 30th year. And then things start to come back a little bit. All said and done, the 100,000 grows to 629,000. Sounds pretty good, except for what? This is not tax deferred. It's not tax sheltered. You have to pay taxes. And if we just put in a 24% tax rate, you would think a quarter of the money goes away. Actually, more than a third goes away. Why? Because you not only lose the money you pay for tax, but you don't get the compounding from it. So if I just put it back to zero, we can see the first year you earn 16%. And so your 100K grows to 116,000. And then the next year you earn 11% off that 116,000 that grows to 130. Again, if I put the tax back in, what happens? Well, after you pay $39.50 in tax, You don't have 116K compounding, you have 112. So when you earn 11% off that, it only grows to 122. So taxes are a really, really big deal. Now, this is the same $100,000 account, but instead of keeping it all in here, we're going to withdraw $14,445 every year for 10 years to fund a 10-pay whole life policy. And you can see the first year, it's the same thing, $100,000, earning 16%, paying $39.50 in taxes. But since we withdraw $14,000, we don't end up with 112, we end up with 98. And so the story goes. Now, if we look all the way down, we can see we don't bleed the account dry, which is pretty good. We were able to squeeze $144,000 out of a $100,000 account after 10 years and still leave about $11,000, $12,000 behind. And that keeps compounding over time with the yields to end up with $23,000. Now, just remember the $23,300. It's not super significant, but the reason is if we just add that to the actual policy. So this is a policy from today with today's low dividend rates. We can see the $14,445 being paid into the policy over time. If we just go to year 42 of the study, you can see we end up with $597,700 plus $23,300. That actually gets us to $621. Which is very, very similar to the $629 that was the ideal if you had that great savings account where you paid no tax. Why is that? Well, it's because life insurance has a steadier yield over time because a friend of mine put it this way, you're actually buying the average. So since lots of people are constantly paying premiums and the life insurance company gets to invest this, not only at the short-term rates, but longer-term rates, and they pass on that average to everybody. You own a share of the average. Also, when you own a whole life policy from a mutual company, you're actually part owner in that company. And share in the underwriting profits from the other lines of insurance, whether it be term or disability or long-term care or whatever that looks like. Now, one thing people don't realize is that taxes are going to go up for everybody. And I don't mean just because of this, the fact that we have $33 trillion of national debt, and this is actually overlaid on the history of the highest tax brackets in red and lowest. So people think taxes are high now. You ain't seen nothing yet. But even if things don't change, even if Congress doesn't meet, the tax brackets that we're in now from the Tax Cuts and Jobs Act are temporary, and they're set to change to revert back to how they were in 2017 at the end of 2025. So what we can see is this 24% bracket. If this is where your income falls, well, that's going to turn somewhere between the 28% bracket and the 33% bracket. So if we just go back to our calculator and see, well, wait a second, that was at 24%. We lost a third, over a third. At 28, we went from 629 to 381. What about 33%? Well, we went from 629 to 348. So when you get a whole life policy, not only are you locking in the smoother long-term average yields from not just the shortest term treasuries, but from lots of investment instruments, you're also locking in some immunity to taxation. So this could change very quickly with the stroke of a pen. Again, right now you might be paying 24% and the pen's already been stroked. You're set to go to this 28%, which is kind of scary. Now, a lot of you are looking at this picture and saying, I like that green triangle at the end there, but I don't like how for a lot of my life, the red is beating the green, and that's why I'm not doing this whole life thing. I don't want to be behind even for a little bit. And this is totally normal. We get this a lot. But something is not fair about this picture. What is it? Well, with the red account, we gave it the benefit of hindsight. We gave it the yields of the past, but the whole life policy dividend, like that's being shown here in yellow, we're just isolating it right here at its lowest point in the chart. And unfortunately, with today's software, I can't plug in what past dividend rates would have been to show you what would have happened. However, another insurance company, actually the same insurance company, did a study from one of its policies back in the 80s. And what it found was it actually kicked butt. Again, something that people don't like, and this is one of the facts of life with whole life, is when yields spike in the short-term rates, they don't necessarily spike for the dividends right away. In fact, you can see it lagged in the beginning, and some of you may thinking, well, that's why I'm not doing it, but wait until you see what happens. But since life insurance companies, again, are constantly investing lots of dollars all the time and passing that on to all its policyholders, you get the benefit of those longer term yields, which creates a smoother yield glide path over time. So when the short-term yields dip and you were getting nothing, you're still getting something, and your growth may feel like that since, again, you're not paying taxes. It might even feel like more if you're in one of the higher tax brackets. But let's look at the numbers. If we look at this old policy from 1980, well, what happened was in the first year, right, your dividend was exactly what it was supposed to be, because we saw that whole life lags a little bit because it takes a long time for the insurance company to get all those dollars and deploy it into something that will help all the policyholders that's fair. 5 years later, notice the dividend was only going to be $2,286 and it was $5,104. So it was more than double what it was supposed to be. 10 years later, you were supposed to get a $4,200 dividend, and now it's $9,000. 15 years later, you were going to get a $5,400 dividend. Now it's $12,005. 20 years later, you were going to get a $7,000 dividend. Now you're getting $18,000, more than 2.5x what was proposed for you to get. Now, what's very, very interesting about this particular policy is it started with an 8.27 dividend yield. Yet after 2001, all the future dividends were lower than what was originally illustrated. Now, if you're in just a typical high yield savings account, you get what you get. But with whole life, again, since the dividend's just a factor and you benefit from that early compounding and it keeps stacking on that early compounding, well, look what happened. Even though you're supposed to get a lower dividend, in 2005, you were supposed to get a 9,000, you got a 19. In 2010, you were supposed to get a 10,000 dividend, you got a 25. In 2015, you were supposed to get 12, you got 33. So this is a benefit that is, again, it's complicated, it's hard to explain, but it has to do with once a dividend is declared and it's rolled back into the policy, it does get added to the guaranteed cash value, which increases your future cut of all future dividend pools. And so you get this compounding, this stacking effect that you don't get in high yield savings accounts, where you're just subjected to the fluctuating and fickle yields of the day that will probably continue to ebb and flow as the economy gets frothy and we fight inflation, or we're coming into recession and we need to stimulate the economy. Whole life is your way out of that for a portion of your reserves that you would like to keep liquid, because you can always borrow against 95% of your cash value, but benefit from not only the smoother long-term growth, but also the tax immunity as well. And if we just stack what the old policy looks like to the new policy, well, remember the ideal was 629 with no taxes. It was 409 with taxes. How about $1.2 million, right? Not 621 like the other policy, but $1.2 million. I think a lot of people would take that. The other thing that's worth noting is if I go in here and talk about the difference, the most you're ever upside down by deploying from the early 80s is $11,000. And that's in the fourth year, where your savings account was $144. And if you did a savings account and put money into whole life 4 years into it, you'd only have 133. And I realize a lot of you don't want to be missing 11 grand, but it's funny when I ask a lot of you, hey, if you have $144,000 in savings, when's the last time that's been below 11 grand? There's like crickets chirping. Nobody never. So think of it that way. Anyway, I hope this helps. If you'd like to see a policy for yourself modeled and how we can move money from one pocket to another pocket, I strongly suggest you go to our calendar at bankingtruths.com/schedule, get with one of our experts. We can talk about different resources you have and custom fit you with one of today's policies to see how you can benefit. Hope to talk to you soon.